Welcome everybody to our year-end tax video series. It's that time of year where we've put our heads together to think about some tax items to talk about and discuss before year-end. Today we're going to be talking about dealership-specific tax planning. I'm joined with Jacob Pardue. Jacob, if you don't mind, just kind of introduce yourself and tell people what you do here at HHM.
Yeah, absolutely, guys. So my name is Jacob Pardue. I'm a manager here at the HHM's Dealership Services Group. I've been with the firm going on 7 years now, and work in conjunction with dealers of all sizes for tax plannings and needs that we're going to discuss here today.
Let's dive right in, and let's start with expenses. So when you're talking with clients, how do you have this conversation about tax deductions and timing and just budgeting and trying to figure out what's best for that client and what are some items that you think are in key importance?
Yeah, so expenses and controlling your expenses it's a hotter topic this year, right? Gross profits are in general coming down across the industry. And so as gross profits drop, people are going to consider their expenses more, right, to stay profitable. So the past couple of years, a lot of our dealer clients have been able to be, open pockets with expenses and things and still be incredibly profitable. Especially depending on your OEM, right? There's some manufacturers that are still having success. Grosses are still high. There's some that are low. So making sure that if we're on that lower side, if we're not experiencing the high grosses that we've had in 21, 22, 23, what can we do to kind of plan and control and get our P&L back in line with what we want it? And so there's a couple things that we're discussing with clients as far as controlling their expenses. A big one is revisiting your contracts, right? Contracts and subscriptions, making sure that, hey, the cost is in line, we're getting value with what we're paying for. Another thing that can kind of sneak up on people is looking at your payroll and pay plans, right? So making sure that, hey, our pay plans are still in line with the dealership's ultimate objectives, right, which is making profit. So making sure that those aren't out of line, people aren't being overpaid or paid incorrectly, right, for the services they're providing. And then just general eliminating waste and inefficiency, right? So if you're spending, if you've got ad spends that aren't driving leads, if you've got, credit cards are all over the place, right? And your employees are racking up charges and you haven't done a good job collecting receipts or things like that. Tying up those loose ends, I think, is really important. And then another piece that I think may not in 24, but going into 25 and 26, would be if we continue to be in a declining interest rate environment. There could be some opportunities to refinance existing debt, right, and lower some of your financing charges and interest charges that the dealership holds.
Awesome. Let's talk a little bit about maybe benchmarking their budget. What are some resources or some things that you can point people in the direction of to help them kind of gauge how they're doing maybe against their peers?
Yeah, so first and foremost, I think benchmarking and budgeting, I think our good operators and CFOs are doing that frequently, right? So they have an idea of where they are, and not only where they are, but where they stand, not amongst their peers, yes, and then against previous financial periods as well, right? So the biggest data set that you're going to have is your previous financials, right? So making sure that you're tracking your expenses, your grosses, your revenue, right, against previous financial periods is going to be, hey, curtains wide open, right? You can see that. And then the next best piece, which I think is also very healthy, is benchmarking yourself against your peers. Now, where can you find data from your peers? It could be your 20 groups, right? It could be publicly traded data or publicly available data from some of the bigger corporations. And then also, HHM can help provide benchmarking services as well to see, hey, these things are in line, these things are out of line, and how can we fix it?
Awesome. As we're coming up to year end, especially thinking about December 31st, what are some of those tax items, specifically for deductions, that maybe need to take place before year end, and kind of maybe talk about the balance between accelerating expenses or maybe pushing some out?
Yeah, so, typically your recurring expenses, are going to follow in a similar pattern throughout the year, and those are going to be captured with your daily activity. The non-recurring expenses are things that we can really take advantage of, right, and can sneak up on you if you're not planning correctly. So things like foreseeable, maintenance and repairs, year-end bonuses, pushing management fees to a management company. These are all great ways that you can move expenses from potentially a future period for tax purposes to the current period. Another big piece that we want to talk about would be acquiring fixed assets or property, right? So if there's a big machinery or equipment purchase that you need to make for your dealership, titling loaner or rental vehicles into a fleet before year end, these are all things that are great where we can take first year accelerated depreciation for tax purposes by just moving them into the current period. And then finally, I think, talking about LIFO, which has been a hot topic for the past couple of years, but LIFO is something that while you don't necessarily need to plan for it as the dealer, that's something that as we see inventory level rise, we can pick up some deductions there as far as LIFO, whether you're already on it. And if you're not on LIFO, considering that, because again, as the inventory increases, so does that deduction.
Let's just briefly speak about maybe cost segregation. If you've got anybody acquiring certain properties or certain other locations, just briefly talk about what a cost segregation study conversation could look like with their CPA, or to let them be aware of.
Absolutely. So especially on acquiring a new property, a cost segregation study is an awesome way to accelerate quite a bit of deduction for your real estate, right? So the way typically a real estate transaction would work is you purchase a piece of property. The building piece gets depreciated over 39 years. Well, with a cost segregation study, what that allows us to do is allows us to break that building up into parts that have shorter depreciable lives, therefore allowing us to take bonus depreciation on up to 30 or 40% of the building acquisition cost. So, a good cost segregation study can save 6 figures in taxes.
Awesome. Let's flip the conversation a little bit now, balancing with, we've had a conversation about all these deductions that we can kind of try to gauge on which ones to accelerate, maybe which ones to push out. Let's balance that conversation with loan covenants. How can you be also keeping loan covenants in mind, make sure you don't do something that maybe could cause an adverse effect on the back end when it comes to your financing partner? And then what are some year-end things to be looking at in conversations maybe to be having?
Yeah, so loan covenants, kind of a dirty word, right? And they're starting to creep back up in our conversation with clients again as we move from these COVID explosions of profits and good times to some slower periods and lower profits, right? So, especially if you're with a store or a manufacturer that's slowed down a little bit, it may be a good idea before the year ends to dust off your loan documents and look at the covenants if you have some. So typically, we see two types of covenants. It's either tied to the balance sheet or tied to the profit and loss, right? And so your balance sheet loan covenants would be like a working capital requirement. So making sure that our current assets are in line with where they need to be and our current liabilities are low enough where we can meet a working capital requirement if that's a piece of the puzzle. On the profit and loss piece, typically like a debt service would be what you're looking at there. And so taking a modified income, and this is something HHM can help with, where we typically find like an EBITDA, an earnings before interest, taxes, depreciation, and amortization, and making sure that ratio covers your debt service, your principal and interest payments for the year in accordance with what the bank's laying out. So planning around these things is becoming it's becoming a topic again. We want to consider it. There'll be questions that we'll be asking with our clients, right, as we're doing our tax planning. And then, as we talk about pushing expenses into the period, we want to make sure that, hey, we're staying in covenant with the bank. We're not knocking that income down too much. We're not crushing the balance sheet too much to where, hey, yeah, we don't pay tax anymore, but now, hey, by the way, you are out of covenant with the bank. Right.
That's awesome. Thank you so much for coming on. Thank you guys for watching. You can find more information on our website, hhmcpas.com. There should also be some contact information there. You can reach out to our firm, anybody that you might have a specific question. And we thank you for watching this, and we hope to see you in the next one.